Hi friends, I am Kevin Shaji, and in this video, I would like to cover an important financial variable, that is EBITDA. What is EBITDA is important. It helps to understand the cash that is being generated from the business. So it is useful measure to understand the productivity, capital returns. That is capital that is invested not just by the equity shareholders but also by the debt shareholders. Debt fund providers. They're not shareholders, they're fund providers. Without impacting the interest base, asset base, and tax expenses. So how we do that, I just explain you by explaining the formula. So it is useful for understanding the cash generating capacity of the business. So what is the formula of EBITDA? EBITDA is equal to PAT plus in taxation plus interest plus depreciation plus amortization. This formula I will explain you in detail. But before that, I need to explain you why do we need this variable? We need a variable that understand the cash is what cash we are generating from the business. So that cash generation from the business need to be understood not by equity shareholders, not only by equity shareholders, but also by the debt providers as well as by other stakeholders. So all these stakeholders want to see how much the business generated cash. So that's why we are adding back some numbers which are actually payment to some stakeholders. For example, we are adding back taxation, which is payment of uh, payment to one stakeholder, that is government. Similarly, we are adding back another variable, that is interest. What is the interest? It is actually paying payment to one stakeholder, that is debt providers. So for all the stakeholders, they want to see how much is the income that is generated from the business. So we are finding out from this variable how much is the actual income, cash flow generated from the business. That's why we are adding back taxation, interest. And then one question will come, why we are adding back depreciation and amortization? Because the formula says we have to add back taxation, we are adding back interest, we are adding back depreciation and amortization. We are adding back depreciation because it is a non-cash expense. What we are doing when we are buying an asset, we will pay cash or we will incur the expense, but we will not consider it is a revenue expenditure. What we'll do, we will divide this expense to number of years of its actual life. For example, if the asset life is 10 years, we will divide in the next 10 years. So that's why we depreciate for 10 years. So every year we will be depreciating a small portion of the asset. That is depreciation. So while computing profit, we will be reducing it. But for computing the cash that is generated from the business, cash that is generated from the business, we should not add, we should not deduct depreciation because this is not a cash expense. It is an emotional expense. We are assuming that the life of asset is 10 years. So every year we'll be reducing a small portion, we'll be reducing that portion of the asset. So since our objective is to find out the cash that is being generated from business, we will have to add back the depreciation and amortization that we have debited in the P&L. So that's why the formula is EBITDA is equal to PAT. On that, we are adding back taxation, which is this amount that is paid to one stakeholder, that is government. Then we are adding back interest, which is also a payment to another stakeholder, that is loan providers. And we are adding back depreciation and amortization, which is not a cash expenses. Okay, now let's just wait. So I'll remove this here. Why EBITDA is useful? For whom this is useful? This is useful for analysts, investors, and all. Why? Because they can understand the operating cash flow before paying to various stakeholders, as I told earlier. That is, we are before paying interest, before tax expenses. Why this is useful? So first thing is all the stakeholders can understand what is the income that is generated from business before paying to all the stakeholders. So So this is useful because we can compare between different entities. For example, there is one entity which is running in a place where there is a tax, where there's another entity which is running in a different geographical location with different taxation rates. So that comparison is difficult with PAT because PAT is after reducing taxation. So we need to find out a variable where we can compare. So this EBITDA is useful tool because we are adding back the taxation. Similarly, if you want to compare between same line of business, but one entity is levered, means some one entity is having debt component and equity component, whereas there is another entity which is having 100% equity component. So if we compare between these two entities, we can't compare with PAT because there is an outflow interest to debt providers. So we should find out, actually, if we want to compare between these two entities objectively, we need to find out the cash that is being generated. So in such situation, we use EBITDA. So I just told you how the cash flow progress that is explained here. If you see the cash flow from business is actually EBITDA. On that, we will reduce provision for depreciation and amortization, which is actually a provision for the provision based upon the life of asset that we are using. We have so many fixed asset for a long period of time, and for this long period of time, we need to give a provision for depreciation. And after reducing provision for depreciation, the amount that is balance available is what you call available for debt service, for servicing debt, as well as for servicing the equity providers and for paying the taxation amount. So after reducing interest and after reducing taxation amount, what we get is PAT. So this is the flow of income. So actually, EBITDA is this simple. Means we are why we do EBITDA. I told there's a formula. That formula for EBITDA is PAT plus taxation plus interest plus depreciation plus amortization. My aim by this video is not just explaining this formula, but how to make this variable more user-friendly to investors and analysts. For that, we may have to make some adjustment in EBITDA. What all adjustments are required in EBITDA is being covered in this video. Why we do adjustment? First of all, we need to do adjustment to find out the true cash generated from business. Sometimes there can one instance I will tell. Sometimes there can be business. Sometimes there can be cash flow, cash expenses, which is non-recurring. So we should not consider that for our decision making because in future that may not happen. Ultimately, an investor or analyst look how much cash will be generated in future. We are looking at the past for understanding the future because investors and analysts is worry more on future than on past. So for that purpose, we need to make some adjustment in EBITDA. And that what all adjustments are we do is being covered here. So first one I will cover is owner and related party remuneration. First I will remove this. Yeah, this is the place. So as I told you, this is we are finding out is cash that is being generated from the business. So for finding out that, we need to add back this remuneration paid to related parties, which is not actually required. For example, this directors or the shareholders, major shareholders, they are in a position to command. They have a higher power in the entity. So what they will do, for the benefit of them, they may increase their share of remuneration beyond what is required, thereby reducing the profit. But that is not an actual understanding of the cash that is generated from the business. For understanding cash that is generated from the business, we need to find out what is the rational remuneration that is to be paid to these people, and whatever excess payment that we make to them should be added back. So in business like private limited companies, owners will have control over their remuneration to be paid. So they may pay higher or lower remuneration compared to a third-party manager. So owners will decide higher remuneration bonus. Why do they decide? Because they want to save taxation. Because why? If we decides not to withdraw the amount, if they withdraw the amount as share of profit, means as dividend, they have to pay tax in the company's hand. Also, when they withdraw the money, they have to pay dividend distribution tax. So what they will do, instead of withdrawing as share of profit, they will withdraw as remuneration. So when they do when they withdraw as remuneration, what is impact? We will reduce from PAT, meaning we will reduce from profit before tax, meaning we will reduce the taxable income, thereby reducing tax in the company. We will also avoid paying the dividend distribution tax, and that will be taxed in the name of individuals. Individuals will have some benefits of basic exemption limit and slab rate taxation. They will take the benefit, and for getting this benefit, they will show higher remuneration in the name of the company. But whether this is actually required, that is a concern, because if you are appointing a third party for the same role, they may not pay the same remuneration. So we need to add back those things. So that is one reason we need to find out what related party remunerations are there, and we need to find out whether it is reasonable or not. If it is not reasonable, we should add back. Similarly, sometimes entity may decide to pay lower remuneration to the promoters, but uh, what do you call it? If you are a third party person, they may ask for higher remuneration, because ultimately in future we don't know. They may ask for higher remuneration. So we should have rational understanding of remuneration that is payable to the related parties. So in order to remove owner bias, we need to add back superfluous or understated remuneration and add back remuneration of third-party managers providing similar service. Also, in the financials, they may book some personal expenses, say like insurance or club expenses, accommodation expenses. These are technically required to be paid by the promoters from their own from the share of profit, but they will show for reducing taxation or whatever reason it is. So that cannot that is not showing the true figure. So that also we need to add back to EBITDA. Similarly, if there is a high salary or remuneration paid to family members, that also should be added back. So these are all we call as owner's bias. So that should be adjusted for finding out the true EBITDA. Then only we can compare between entities. Next one, revenue or assets. Revenue or expense from asset which is not in use. Suppose, as I told you earlier, we are finding out EBITDA to make a decision. Why are we doing this? Because we need to find out the future cash flow. Future cash flow has some reflection of the past. So, but need not be 100%. There can be some changes in future. For example, we until now they may be using a machinery that whose life is already got, and we are going to purchase new machinery. Because we are purchasing a new machinery, the cost that's incurred for maintaining the old machinery will not be required. Suppose last year they purchased new machinery as well as old machinery is also operational. But this year onwards, the old machinery is not being used. So in this situation, should we consider the cost of the old machinery? No, not required. No. So or expense of an asset which is not productive to be added back. If the asset's life is over and if it is damaged before beyond repairs, then we should not add those. We should not consider those expenses for finding out the adjusted EBITDA. We should add back. Similarly, income generated from assets that whose life is already over, that also should not be added, because ultimately our aim is to understand the cash generating capacity of the entity, not the historical values. So this is the reason why we should do this. Transaction with related entities, persons not in arm's length. So an entity will be doing transaction with a holding company or transaction with so many group companies. One concern is whether these transactions to these related parties are in arm's length or at the right price. What they will do, they may sometimes charge higher or lower price. Suppose we are giving, say, like we are going to invest in a subsidiary company. So in the subsidiary company, the subsidiary company is reporting huge profit. But when we analyze, if we find out that it is because the cost is lesser. Why the cost is lesser? They purchase materials from a holding company, and the holding company is pricing at the lower rate. So what does it mean? What does it mean? It means that holding company is pricing at a lower rate compared to their other customers, so that the financials of the subsidiary company looks good, so as to attract investors. That's the right manner. So what we'll do, we have to understand the actual market price transactions, compare with the prices that is being done between related parties, and if there is a difference, we need to adjust. So transaction with related parties may be at higher or lower price. So we need to find out the market price and we need to adjust. This situation occurs when there is a transactions between holding company to subsidiary company, or even another example is sometimes there are multiple group companies. They may use the employees of this group companies at inadequate consideration or at a low consideration. So that also will show a wrong picture of EBITDA of this company. So we need to understand that we need to add back or reduce based upon the nature of transaction when we compare with the actual market practice. So this is very important to understand. Then only we'll get the right EBITDA. Then only we'll be able to find out the right cash that is being generated from the business. Yeah. Next one is extraordinary income and expense and assets. First I'll cover extraordinary income and expense. There are very few asset variables that there is only one, technically there is only one asset variable that impact the EBITDA, that is stock. So first I will not cover that. First I'll cover extraordinary income and extraordinary expenses. What are these types of extraordinary income and expenses? Suppose an entity in the current financial year booked insurance claim because of some damages that have occurred. This insurance claim is not recurring. So should we consider those income? No, should not be considered. Similarly, the damages that occur, the loss of damage is also not recurring. So that also we should find out the impact in future before add impact. We should understand the future impact. That is very important. Okay. Then lawsuits and arbitration. You suppose when there is a case, because of the case, because of some court cases, we may have a huge cost, and that is not recurring. In that situation, we should add that. So there are so many examples like this. However, ongoing lawsuits, sometimes there can be continuous lawsuits because of the nature of business. Then that should not be added back. And regular warranty cost, because based upon the based upon the production, they may find out there is some percentage defects. Because of that, there can be a regular warranty cost. This warranty cost and all we should not add back if it is regular in nature. Also, making provision for expected bad debts on trade receivable also should not be added back, because if that is recurring in nature, in the market there will be some bad debts, then we should not add. Only extraordinary expenses and extraordinary income should be adjusted. Similarly, one-time professional income for R&D, marketing, training costs, that can be added back or reduced. One-time professional income for, if you are, suppose you are having one R&D activities, then we have some expenses. That expenses we should add. And stock is one of the assets that is there in the P&L, and that impact EBITDA. If the stock, if there is a non-moving item, we should adjust that, because non-moving assets cannot be sold. So we should adjust the stock value. So this video, I hope, will be useful for you all. If you have any queries, please comment in my comment box. and wish you a happy day. And thank you for listening to my video. Bye.